Representing a taxpayer in audit and examination process. So basically, a taxpayer calls it an audit, okay, if the IRS has, sent a letter, okay, for their examination. Taxpayers typically call it as an audit, okay, and IRS typically calls it as an examination, okay, but it doesn't mean the same thing, okay. Basically, this process is what IRS has an authority to examine books, papers, records, or any sort of supporting documents to see that if the taxpayer has filed the taxes which are accurate, okay, and taxpayers has not taken out deductions which were not allowed, or taxpayer has not omitted any of the amounts that they were supposed to be included, okay. So basically taxpayer gets a written request for documentations to be submitted to the IRS by means probably by email or in person, okay. Certain electronics documents also could be accepted by the IRS if you are maintaining your books of records in by means of certain documentations. So as we know that a certain expenses to be deductible, it should meet up with specific criterias. And if the IRS sees there is a problem with that, then they might get into an audit. Okay, and oftentimes the burden of proof is with the taxpayer. The taxpayer has to prove prove that the amounts that they have taken as deductions are correct and valid. Okay, so taxpayer can typically do that by supporting their documentations by means of cancel checks, bills, or receipts that they have. Okay, taxpayer can typically request for a convenient time and location. Usually, IRS decides the time and location for an audit. Okay, time and location. But if the taxpayer sees that that's not really convenient for him, he could request, okay, that the audit happens at a different place, which is convenient for both the IRS and the taxpayer. Oftentimes, this is approved. Okay, as long as this is good for the audit. Now, IRS typically gets into an audit by means of certain random selections. Okay, random selection. So, computer programs helps the IRS to see that which uh, you know returns needs to be selected for an audit. So that's called a random selection, or document matching. Okay, these are the two ways that IRS decides that okay, these are the returns that needs to be audited or examined. Okay, so usually there is a document matching that the employer has to send the IRS a W-2, okay, wages and salaries and wages. Okay. Also, employer gives one copy to the ARS, one copy goes to the Department of Labor, one copy goes to the employee. Okay. So the employee has to pick up data from W2 to show his salaries and wages, bonus, commissions, and everything. So if there is a mismatch between the W2 forms that IRS already have on behalf of you and what you have filed on 1040, if there is a mismatch, then of course your documents or your return would be selected for audit. So if the return is selected for an audit, it doesn't mean that always there could be a problem. There could be instances wherein that the taxpayer has filed everything correctly and there was a mistake in W2. Okay, maybe there could be other problems. Okay, or if you're an independent contractor, then basically you file something called a 1099, okay, for an independent contractor. So if figures are not matching with the documents that IRS has already have, okay, and with the taxpayers um, filing data, of course the return could be subject to an examination. Okay, so The audits typically happens could be based on in the office of the IRS, okay, which we call it office audit, and or it could be field audit, okay. And a field audit is typically time consuming, and it takes a lot of resources from the IRS to conduct a field audit. So oftentimes IRS prefers an office audit. Now, this office audit could be by email correspondence or by telephonic. Okay, the IRS might call up the taxpayer to basically send certain documentations to support their filing. Okay, so audit notification happens by mails or by telephone. Of course, the taxpayers has many rights during an audit. Okay, so the taxpayer definitely will have to be treated courteously by the or professionally by the IRS employees, and they have a right to keep their confidentiality and privacy during an audit. And of course, there should be a right for the taxpayer to ask questions to the IRS, which relates to the audits. Okay, a right for representation. This is very important because oftentimes the taxpayers get intimidated, get confused during an audit. Okay, maybe the taxpayer initially thinks that probably he or she could manage it with the IRS during an audit, and probably when the questions come, that's when they get confused and they might ask for a representation. So if the taxpayer is not really happy, okay, is confused, then the taxpayer can request for a stop of audit, okay, audit interview, and request for representations. And IRS has to immediately approve with that. Okay, IRS cannot, deny that if the taxpayer requests for a representation. And of course, if the taxpayer is not really happy with the audit procedures, it can get into an appeals process with the IRS itself um, before it goes to the court uh, courts available in the US. Typically, the audit length depends on the length of the audit depends on the availability of the documentation and uh, um, both parties attending the meetings. So these ways, if there are disagreements or agreements, okay, it depends on how smoothly the audit go. Okay, if the audit goes really smooth, then it doesn't take much time. But typically, a field audit can take several days. Okay, the audit determinations at the end of the audit auditors of the IRS, uh, sends in a letter of determination. Okay, it could happen in three ways. One is a no change audit. Okay, in a no change audit, the IRS does not find any mistakes or errors, and they accept with your filing, and they send you a no change audit. That's what every taxpayer wants. Okay, and uh, it should be sometimes, there could be discrepancies, and the taxpayer accepts with that. Okay, that's what is agreed. Okay, there were discrepancies, and the taxpayer agreed to their findings in the determinations. Or there could be a situation where taxpayer finds or the auditor finds certain discrepancies, and the taxpayer does not agree with that. Okay, that's when it gets into the uh, appeals process with the IRS, or the taxpayer might typically go into the uh, statutory, uh, you know, uh, court's law. Uh, it might fight in the court. Okay, so the outcome of a disagreement, okay, would lead to basically an appeals. Okay. So a conference with the manager, okay, or the auditor who has conducted the field audit can be done immediately. Or if it is again not satisfying, then the taxpayer can request for an appeals, okay, an appeals to be conducted. Okay. There could be typical cases where an innocent file claim could be raised. Okay. Um, let's say there were two spouses who were previously married and divorced. Okay. So if you're filing a joint tax return, typically you are responsible for the items that you reported on the filings prior to your divorce. Okay, the former spouse is liable for any of the sums which you filed during you were married. Okay, so let's say now two of the people got married, okay, husband and wife, okay, and let's say the spouse or the wife, filed a new joint tax return with his new husband, and she was supposed to get a refund. She was expecting a refund, but all of a sudden she gets a letter saying that the amounts are adjusted against her husband's previous returns. Okay, so or uh, certain items is adjusted against the previous returns. In such case, she is denied on her rights, on her due rights of getting a refund. She can request for an innocent spouse relief, as long as she has signed a joint tax return and really did not know about the issues that her husband has, okay, on his previous returns. Okay, so as we said at the conclusion of the audit, okay, the audit might result in a no change audit. Okay, the IRS auditor accepts with your returns. Okay, or it could come up with additional taxes, uh, you know assessments. In such case, the taxpayer can disagree or agree with that. Okay, if it agrees with that, formally, on the letter of determination, the taxpayer has to sign something called a form 870. By filing a form 870, the taxpayer typically accepts with the auditor's assessment. Okay. So if additional taxes are assessed, the typical taxpayer has 21 days, if your taxes are less than 100,000, to pay up without additional penalties and interest. Or if your taxes assessed are more than 100,000 or more, you just have 10 days before the interest and penalties would get accrued to your account. So as we said, the taxpayer, will have to sign 870. If the taxpayer does not want any headaches, then the taxpayer would sign the 870 and pay up the additional taxes assessed, okay, and the interest and penalties thereof in full to avoid any more accruals of penalties and interest. Once the taxpayer gets a 30 days letter, this is called the preliminary letter of 30 days. The taxpayer has typical options of going for the appeals program with the IRS or to pay up. Now, if the taxpayer doesn't do any of that, okay, the taxpayer doesn't go to the appeals or doesn't pay up, then the taxpayer gets something called a notice of deficiency or a 90 days letter. Okay. So this 90 days could be called a 150 days letter if the taxpayer is outside the US. Okay, typical cases could be there, but usually it's called a 90 days letter. Okay, this is the ticket for a taxpayer to get into tax litigation. So before getting this letter, the taxpayer is not supposed to go to the tax courts or district courts or uh, federal courts of claims. So once the taxpayer gets a 90 days later, and then the taxpayer has typically 90 days to go to the courts and fight against the IRS on the additional assessments. So now partnership has a typical uh, issue. Partnership audits have a typical issue. One is, as we know that partnership is a non-taxable entity, they file something called 1065, excuse me, to report their taxes. Okay, this is an informational report. Okay, informational reports, and they don't pay taxes at the entity level. Okay, therefore, all the taxes are uh, f- is flowing through the 1040s of each of the tax partners. Okay, each of the partners, it eventually is taken by the partners on the 1040. Okay, based on the K1s that they get. Okay, now if the IRS wants to audit a partnership, then eventually it'll have to audit all of these partners, because it eventually gets into partners 1040s. So that's a tedious process for the IRS. Therefore, initially we had something called a TEFRA audit, okay, for the partnership. Now, this has been taken over by the Budgets Act of 2015, okay, by which the partnership and not the partners are liable for the IRS deficiency, and that's the only one case that the partnership would be assessed taxes, and the partnership at the entity level will have to pay taxes, okay, by means of Budget Act, okay. So the current partners, okay, would be liable for any of the deficiencies, okay, even for the previous partners. Okay, the current partners are liable for the previous partners deficiencies. So practitioners need to advise the partners um, getting into a partnership agreement or buying partnership stakes from previous partners with regards to these issues. Okay, as we know, the current partners would be liable for any of the deficiencies, assessed by the IRS during the previous years, wherein these partners may not be partners. Okay, these are new partners. Okay, old partners will get free under these provisions. Okay, the new rules do not do not allow partnerships to opt out for this particular TEFRA Act or Budget Act if you have more than 100 partners. Okay, you mandatorily will have to get into this. So let's visualize the tax procedures. As we said, the audits would be conducted based on random basis or by means of documents matching. Okay, it could be done via two ways: office audit or a field audit. Field audit takes a lot of resources from IRS. Office audit could be by means of correspondence or telephonic. Okay, it could be telephonic or by email. Okay, the IRS might send you an email to basically send in the documentation supporting their positions on the tax returns. If they find a tax discrepancy, they would ask you to basically sign a form called Form 870. Okay, so once you sign the Form 870, which means that you're agreeing with their assessments, so therefore you are actually waiving off any of your rights to go to the tax courts to fight against the IRS. So as once you accept, then basically you sign the 870 and then pay off the further additional assessments. Now, the taxpayer refuses, then IRS will send you a preliminary notice of 30 days later. So once you get that, you have 30 days to either appeal for their decisions or agree to pay. If both of this doesn't happen, okay, you're not filing for an appeal, neither you're paying, you get something called a notice of deficiency, which is called a 90 days letter. That's when you could get into litigation against the IRS. So you cannot begin a litigation against the IRS unless you get a notice of deficiency. Okay, so these are the typical processes associated with the audit process. Of course, if you are not happy uh, with the audits, or if you want to basically fight against the um, the IRS, you got a 90 days letter. Okay, that's your ticket to get into litigation against IRS. You have typically three courts: U.S. court, tax courts, U.S. district courts, and U.S. courts of federal claims. Okay, so if you're getting into tax court, they only hear tax cases. Okay, and the trial is by the jury. You do not have to pay before you get into a litigation against the IRS in the tax court. You don't have to pay. Okay, but if you're getting into US District Court, you have to pay first. Okay, um, so this particular court not only hears tax cases, but they hear every other cases. Okay, so the payment is required, and the trial is with a jury here. Okay, now you also have an option to go to the Federal Court of Claims. Okay, they basically deals with money damages against US. Here also you have to do the payments first, and the trial is by a judge. Okay, so what if you're not happy with their verdicts? Okay, these two courts has an appeal court which is called Geographical Court of Appeals. You could appeal under the Geographical Court of Appeals to handle cases on taxes, okay, of tax courts or district courts. Now, Court of Federal Claims has an appeal court which is called Federal Court of Appeal. You could appeal the decisions from the Federal Court of Claims to the Federal Court of Appeals Court. Okay, and if you're not still happy, you could even go to the Supreme Court, which is very rare because they do not typically hear any of the tax cases. That's about audit process. Good luck with your studies, guys.